How are you today? Hope you have been having a good experience, an excellent experience as you have been following and learning the concepts of accounting. This is Kings and Queens accounting class, and we seek to make the content simple and to give practical exercises to clarify each concept as we share them with you. So welcome again as we proceed to go a little bit further into the accounting course. But just before we go any further, I want to say to you that if you like any of our videos, we ask that you click below the like button, and you may also click the subscribe button so that you can be given a notification every time that we are posting new videos. So let's begin. Adjustments to final accounts. And today we're looking at bad debt. We're looking at bad debt. How is it that bad debt arise in businesses? But just for clarity, we always seek to direct our lesson with objectives. We want to look at what is bad debt. We want to look as well as how do we write off bad debt, and we also want to look at how to treat provision for bad debt. All right. So let's get into it now. The matter of bad debt. How does that occur in businesses, and why is it that business owners allow themselves to be trapped into this situation? Might I place before you that business transactions are done in two ways. One, by cash, or what we know as check. And of course, in today's age, we may use credit cards and we use debit cards. All right. All of these are transactions where payment is taking place. Sorry. But there's a second method of conducting transactions in business. Excuse me. And that is credit transactions. Transactions where we are buying or selling goods and are being given the privilege to pay at a later date. So, referred to as credit transactions. All right. Now, this is the transaction the type of transaction that really lends itself to businesses incurring debt. Now, no business wants to have debt, but it is a normal business risk, right? Because the business owners or the company wants at best to make sure the goods are in the hands of the customer, which gives them a better chance of being paid for the goods. So credit transactions causes us to have debt. When we sell goods on credit, then we have a credit customer, and this credit customer is called our debtors. So once there is a credit transaction, a debt occurs, and the person is referred to as the debtor, and or otherwise this is referred to accounts receivable, right? So a debtor is also referred to as accounts receivable. But once a credit transaction is taking place, then a debt is being put into existence. And once a debt exists, then we will now have a challenge in obtaining whether or not obtaining the payment for it. So, arising from this method of payment, or the method of conducting transaction, we incur debt. And some persons do not honor their debt. In other words, they don't pay up. It becomes difficult to obtain from them. So what happens is when they are difficult, when we have a difficulty in obtaining, yes, the payment from our credit customers, then after some time we may decide that, well, we cannot get the payment from them, and so we're going to really write it off as bad. So then we come to the idea of bad debt. Now, a debt is referred to as being bad because the company is unable to collect payment. The company is unable to collect payment. Right? And so we have a debt referred to as being bad. Now, how do we? So we understand what is bad debt. Bad debt is any debt that we feel that we are unlikely to be paid, or we are unable to collect, yes, from those customers who owe us. All right. Let's go to the next one. So now that we have the debt, how may we now write off that debt? All right, how are we going to write it off? I want to establish that bad debt is an expense to the business. And the question is, why is bad debt an expense? Here's what it is. When we buy some good, let us say we're doing a retail business, buy and sell. We buy something for $200. We spend our money and buy for $200. Right? And then we're intending now to sell it at a profit for $300. So we're selling it for $300. Now, what happens is that when we have sold these goods for $300, yes, to the person, and we sold it on credit, we can't collect it. And because we can't collect it now, we write it off as being bad. So who bear the cost for this good that we have purchased? We bear the cost. So it's an expense to us. We would have spent our money. We would have expended our money to buy the goods, and we sell it to somebody, and we are unable to recoup, yes, the money that we would have spent. And so the goods, so that no, bad debt is referred to as an expense to us, our business. Now, how do we write it off? And we're going to look at the double entry arrangement in writing off bad debt. So this is what happens. First of all, the debt must exist before we can write it off. So if this is the debtor's account, let us say the debtor is Mark. Put some name here so you can relate to it. And this is bad debt. The first thing that must be established is that there is a debt. In a debtor's account, the debtor is a current asset, and current asset carry debit balance. So the balance will be over here. So let us say it is balance brought down of $100. And we're going to write off that debt. To write off the debt, we must now credit the debtor's account and then create the bad debt by debiting it. So we are taking it out of the debtor's account because we're writing it off. And we're creating a debtor's account by debiting it because it's an expense. And remember now, asset and expenses are treated the same way, right? They carry a debit balance. All right? Now at the end of the financial year, when we're going to charge it to our profit and loss account, or our income statement, we're going to move the bad debt from the debtor's account, and then we are going to put it in the profit and loss. So the action is to credit the bad debt account and debit the profit and loss, charge it in the profit and loss as an expense. That is the process of writing off bad debt in form of a double entry. All right, we're going to take on a transaction right now and do it officially. Here is a question. D. Blake operates a grocery shop. On May 31st, 2018, he decides to write off his bad debt. The debt of K. Green of $60 and R. Wint of $80. Right? We're going to stop right there in that question, right here. Because that is what relates to our writing off of bad debt. That is objective 2. So let's see if we can, how we're going to write it off now. The first thing we're going to do is that we're going to open an account for these two individuals. The first one is K. Green, and so K. Green's account, and as well as R. Wint's account. All right. Now R. Wint and K. Green, they have some money outstanding for us as a debtors account. So we're going to have now at 2018 May 31st, the balance that was being brought forward is $60 for Green and for Wint. Balance brought forward is $80. All right. So that is what the account looks like. Both accounts looks like, showing that there's a owing, that there's an outstanding balance that these two credit customers have for our business. And so we're about now to write them off. We decide that we can't get the money from them. Maybe we have called them, we have sent letters, all things we have done, and we still can't get through to them. So we're going to write off the debt, take it off our books, because we don't think that we can recover it. So we're going to write it off. To write it off now, we're going to open what is referred to as our bad debt account. Now, to write off the bad debt, as we have shown earlier, we are going to credit the debtors account and debit the bad debt. So to do that, we're going to have 2018 May 31st, and the name of the other account affected would be bad debt of $60, writing off all of it. So if we credit in this account, we come to bad debt and debit. 2018 May 31st, and we're going to have K. Green is the name of the account here, and it is $60. Okay, so we have written off the account for K. Green. So we can double line this and close it. So we no longer have any business to do with Green anymore. We're writing off his account. We have written it off. So now we're doing for Wint. So we credit again 2018. It was the same time that we did the both of them. So bad debt. Come on. Bad debt of $80. And since we have credited, we're going to debit. So it's going to be R Wint $80. Alright? We can double line this and double line this because we're closing it. We no longer have any business to do with K. Green and R Wint, because we're taking them off our books as being debtors, writing off as bad. Now, at the end of the financial year, we'll be sending the debtors now, charging it into bad debt rather in the profit and loss or the income statement. So if we're using the income profit and loss in the form of a T account, then we're going to be crediting the bad debt account. So it's going to be, let us say it's now 2018, and the end of the financial year would have been December 31st. We're going to have what now? Profit and loss of the total here would be $140, right? And then after having credited here, we're going to debit here 2018, yes, December 31st, and we have bad debt of $140. We can close this off. All right, and so we would have completed the writing off and writing off of the bad debt and transferring the bad debt to charge it to our profit and loss account for that year. That is the first segment of our lesson. We're going to move to look at provision for bad debt. So we would have done the objective 1 and 2, and we're now going to do objective 3, provision for bad debt, and sometimes referred to as doubtful debt. Doubtful debt. Now, ladies and gentlemen, why do we have doubtful debt? Why is it that we would have had doubtful debt? And the provision is arrangement is where the business is saying there is a likelihood, they're estimating the figure that we come up with is really an estimated figure in accounting to determine the possibility that there is certain percentage of persons who might not pay you. So you're making arrangement to deal with it so you don't create any unnecessary shock on the business. So the provision is really an arrangement put in place, right? You are simply making an estimate of the likelihood of those persons who may not pay you. So you might say, all right, I have sold $10,000 worth of goods to some customers. And you're saying, based on experience and based on operational situation, there's a possibility that perhaps 10% of those persons will not pay you or you will not get back, right? Based on the goods you have sold on credit. And so you don't just make that estimate and leave it like that. You want to put the business in a safe position, yes, so that it can deal with any kind of shocks that may occur. So the provision for doubtful debt is open. Now a provision account, may I just put it here, a provision account is treated as a liability. Treated as a liability account, right? And what do I mean by treated as a liability? We mean that liability account carries a credit balance, right? That means when you open the account, your first entry is going to be on the credit side in a liability account, okay? So if you're increasing the liability, you will debit. If you're decreasing the liability, so once it is increasing, you're going to debit, and if it is decreasing, you're going to credit. Right? That is what we mean, that the provision account is treated as a liability, and therefore, if your provision for doubtful debt increases year on year, then it's going to be credited. If it decreases, you are going to debit it. All right? So let's go quickly. The another point I want to bring to your attention is that in treating with the provision for bad debt or doubtful debt, after, and I'm giving this rule again, another rule, after the first year, after the first year, here you're going to record the increase or decrease amount, right? So this rule is very important. So after your first year of calculating the provision for doubtful debt, what you are going to be recording in the account is the increase amount or the decrease amount from year on to follow the following years that would follow. All right, or the years that would follow. All right, so we have established that a provision account is treated as a liability. Yes, means that the account carries a credit balance. And one other rule we want to say is that after the first year, you record the increase and the decrease amount. Let's get it into practice now. From the question we have here presented, Blake has total debtors of in 2018 as 12,000, and for 2019 10,000, and he has in his business arrangement for doubtful debt with a rate of 10%. So let's see if we can work it out now. The accounts that we are going to be opening, first of all, is the provision for doubtful debt. The provision for doubtful debt account. And of course, the next one we're going to open is the profit and loss, the account relating to profit and loss. Profit and loss account. All right. Now, let's do this quickly. So in 2018, we have a total debtors, persons, the amount that owing to us is 12,000. And we are saying it is likely that 10% of this figure we will not get back. So we're going to provide for it. 10% of the 12,000 is 1,200. So we're going to have 2018 December 31st profit and loss, and the amount we calculate, that is, ladies and gentlemen, 12,000 times 10% is going to equal to 1,200. So it is 1,200 here. If we credit, we're going to debit in this account. So we come 2018 December 31st provision for doubtful debt is 1,200. All right, we can double line this because we're not using it for more than 1 year. Okay, now in 2019 we have a total of $10,000 worth of debt and 10% of it. So 10% of the 10,000 is going to be 10% of the 10,000 is going to be what now? $1,000. Now the thing about it is that we compare last year provision was in 2018 the provision was 1,200. In 2019 it is 1,000. So what has happened between here, which is 2018 and 2019? When we compare these two, we realize it has decreased by $200. The provision decreased because last year 120, 1,200, and this year is 1,000. So it has decreased by what? 200. To decrease the provision, we're going to debit. To decrease the provision, we're doing what? Going to debit in the provision account. So we go here and we have 2019 December 31st. Yes. Profit and loss account, and that is going to be now 200. As I said before, record the increase and the decrease. So it is decreasing by 200. To decrease a provision, we debit, right? I said earlier that the provision account is treated as a liability. Therefore, when we are creating the provision, the account you're going to record on the debit side, the credit side, because it's a liability account. So if it is decreasing, then it goes to the debit side. If we debit here, we must credit here, which is 2019, December 31st, yes, profit and loss is 200. What we can do in this account now, we can balance this account. We don't do this, but we do it here. So if we have same December 31st, the balance on the account would be 1,000. Yes, balance CD. So this will be 1,200. Draw it at the same level, 1,200, double line. And you know that once you have a balance CD, you must have a BD. So carry it over to be January, yes, and which will be 2020. And that will be balance what now? BD of 1,000. There you go. In relation to provision for doubtful debt. And that is how we will treat it in the double entry. Just to say one other issue now. How do we deal with the provision for doubtful debt in the balance sheet and the income statement? Well, in the income statement, under expense, income statement, if the provision, let me explain now. This is gross profit. So we would add provision, yes, for doubtful debt. And this is done if the provision is decreasing. So in this case, we'll add, let us say the gross profit was 5,000 and we're dealing this is for 2019, yes, on the year 2019. Then it will be 200 right here. Okay, and so in the income statement, we'll add the provision for the increase amount, yes, we'll add it to the gross profit. Now in 2018, yes, in the income statement, let me do that. In the income statement, we have gross profit. We have, then we're going to less expenses. And so you have provision for doubtful debt. That it will be $1,200, yes? So this is how it affects if it decrease. Yes, this one for this year, for 2019, this is how it will be treated. It will be added to the gross profit. For 2018, yes, this is 2018. This is how it would have been treated. It would have been under the information on the expenses. Okay, so that's how they will be treated dealing with the income statement. Of course, let me erase and show you one last issue that must be considered in the balance sheet. In the balance sheet, irrespective of increase or decrease, yes, under current asset, and you will have your debtors figure. So the debtors of, let us say this is for 2018, which is the 12,000. You would less the provision for doubtful debt of 1,200, right? And in the event for 2000, so in the event for 2019, so this is a 2000 this is for 2018. For 2019, you would have debtors, yes, and that would be 10,000, and you would less the provision for doubtful debt of 1,000. Okay, that is basically how it will be treated for each year in the balance sheet. Okay, Ladies and gentlemen, thank you very much for sharing. I hope that the concept has been clearly shared with you. And if there's any challenge that you have, please let us know. We will be prepared to go a little bit deeper to explain the concepts that you have been challenged with. Let us know. We're here to serve you. This is Kings and Queens Accounting Class. Thank you again.